Today we're going to talk about the interest limitation rule, which is the third of the 4 provisions that we're going to talk about in these sessions. And I hope that it's a simple presentation. I've tried to keep it as simple as possible. It's actually quite a simple provision. And in order to give context to the interest limitation, I'm also going to talk about thin capitalization, simply to give background to how the new provision works, rather than to go into that in any great detail, but to allow you to understand that this is a development from thin capitalization, and it's attempting to deal with essentially the same issue from the perspective of the tax authorities. So let's share screen and we'll get started. Okay, so we're going to look at thin cap and interest limitation. And just reduce that down. And both of them are designed to limit the available of interest deductions, which are used to reduce the amount of profit in a company and therefore reduce the amount of tax that a company has to pay. If you think about it, interest is an expense. Interest is used, will come out before profit, before tax, and therefore the pile of profit which is taxable will be reduced. So the thin cap rules in Gibraltar are a long-standing provision. They've been in our Income Tax Act since it was introduced in 2010, and they're contained in Schedule 4 Part 1. They're one of the original provisions that came in 2010. The interest limitation rule has recently been introduced back in December, January 2019. And it's a development of BEPS Action Point 4. We've talked about what BEPS is previously. This is Action Point 4, and it's designed to stop the utilization of interest as a method of avoiding tax. And its implementation is mandated on us by the Anti-Tax Avoidance Directive, ATAD, which again, we've spoken about previously, and we've discussed the position as to whether we need to introduce this as part of our EU status. This was required whilst we were still a member of the, well, we were still an EU territory, I beg your pardon, and it's been in our law for some time and applies to any accounting period which finishes after the 1st of January 2019. So let's talk about thin capitalization first, because that's the previous provision which attempts to do the same thing. It's still in place, by the way, and you would need to continue to consider it when you're capitalizing a company. So thin capitalization works by limiting the amount of allowable expense where a connected party makes loans to a company by balancing the loan amounts against the strict capital of the company, that is the share capital of the company. So if a connected person makes a loan to a company and charges interest, rather than injecting capital into the company in the traditional way, then they create a deductible expense. That's the interest payments, and the interest is sent out to the company pre-tax, thereby reducing the amount of profit available for taxation. If the company is capitalized properly, in inverted commas, meaning in a more traditional way, then the payment to the connected persons, instead of being taken out as interest, would be taken out as a dividend or a profit participation, and would be taxable in the hands of the company prior to the payment. It would also be subject in certain jurisdictions to different tax regimes. So we've got a little chart to explain how that works. Company A on the left-hand side, as you look at the screen, has a shareholder which has made a loan to Company A. So its income minus its ordinary expenses minus its loan interest equals its taxable profit. Company B on the right-hand side is in exactly the same position, but it is without a loan. So its income minus its ordinary expenses are as taxable profit. You can see there's an extra element to be deducted. So obviously people would choose interest as opposed to capital as a method of capitalizing the company to increasing its working capital, because it's a more tax efficient way. So there are rules around what you can and can't do there. So the thin capitalization rules describe the provision, and they set a ratio of interest-bearing debt to normal capital of 5:1. And if the payments of interest are to a connected person who is not a company, and the loan is not at arm's length, there's that arm's length principle that we've talked about repeatedly through these sessions. And the arm's length principle is defined as the price that would be charged between a willing buyer and a willing seller acting independently of each other. So the real commercial rate, if we have interest paid, so first of all, we have to have the capital ratio, the debt to capital ratio has to be 5:1 or more. So that's for every pound of capital, there has to be £5 of debt. And the company is paying interest to a connected party who is not a company, and the loan is not at arm's length. That's the main provision that you're going to trigger in thin capitalization. And then there's a secondary provision that the company pays interest to a third party, an unconnected person, and the loan is secured against assets of a connected person, and the loan is not at arm's length. And that will then also trigger the thin capitalization anti-avoidance provision. The anti-avoidance provision is that when you have these two cases, then the interest payments will be deemed to be a dividend to either the connected party or to the third party, however is relevant, and therefore they will not be allowed as an expense against the profits of the company. So you'll see what they do is they basically say, we don't care about the form of your loan agreement. You are outside the boundaries of what is acceptable. You are dealing with a connected party, and you're not dealing at arm's length. It's quite a powerful tool in the hands of the income tax authorities, and it shouldn't be ignored. It's something that's been there forever. Most jurisdictions have thin capitalization rules, many more sophisticated than ours, because our tax provisions are generally aimed at simplicity, because we have limited resources in our civil service. We're not like the UK. We can't just summon up thousands of tax inspectors. So there is a general principle in Gibraltar tax law that it should be as simple as possible to still deliver the aims of the provision successfully. So here we see it's nice and simple. Capital ratio, is it a connected person who's not a company, and is the loan at arm's length? In that case, we will just deem these interest payments to be a dividend. And that, in the case of an individual who receives the interest, and the company earns its money in Gibraltar and is a Gibraltar taxpayer, that would take the individual into tax as well. So you can see that it has ramifications for both the payer and the payee in certain circumstances. So that's fine. Thin capitalization is common across the EU and across most of the international community, but certain jurisdictions within the EU went further than a straight thin capitalization rule than we've got. And they introduced what's called an interest limitation rule. And specifically, Germany was the big motivator behind this. They pushed very hard for this, and theirs was the first, I think it was the first of the whole of the EU. And this goes quite a lot further than thin capitalization, though it's effectively trying to do the same thing, but it uses a bigger stick than thin cap. So this was introduced in January 2019 in Gibraltar, and any financial period which ends after January 2019 is covered by this. So some of the financial periods that you've already dealt with would be covered by this. It's mandated by the ATAD, and it extends the limitations on interest. There are similar provisions right the way through the EU. Because this is a directive, everybody in the EU has got this. Luxembourg has introduced it. Germany and France already had versions, and they've had to standardize theirs to make it so that everybody is the same. So in order to understand the directive provisions, because obviously EU directives are drafted in the way they're drafted, it's best for us to work out some definitions first. And the definitions that we need to understand are, first of all, what exceeding borrowing costs are. The provision doesn't limit interest. What it limits is exceeding borrowing costs. And exceeding borrowing costs are the amount by which the deductible borrowing costs of a taxpayer exceed the taxable interest revenues and other economically equivalent taxable revenues. So you need to deduct the amount of interest that you earn from the amount of interest that you pay. And that gives you the exceeding borrowing costs. Because what they're trying to do is they're trying to stop you from stacking up exceeding borrowing costs in jurisdictions where there are there's a lower tax on interest. So deductible interest expenditure minus taxable interest income, and it has to be taxable interest income equals exceeding borrowing costs. It's bringing that into tax. And this covers all interest. You need to be very aware of this. Bank interest is not exempted from this. Interest from connected parties, interest from third parties, all interest deductible against tax is included in this calculation. Now, there's people always say, "Oh, but bank interest shouldn't be part of it." Well, I'm afraid it is, and so those larger groups who exceed the figures will see an impact if they have high bank borrowing. So that's a very important definition. It's very important to understand that bank interest is covered. Secondly, we need to understand what EBITDA is. I'm sure most of you understand it, but just for completeness, EBITDA is the earnings of the company before interest, tax, depreciation, and amortization. So it's your turnover minus expenses, but you don't include interest, tax, depreciation, and amortization in that calculation. And taxpayer, which is the standard definition for our ATAD provisions and for the ATAD itself. Sorry about that. Which means a taxpayer is an ordinarily resident company which has assessable income and has assessable income under the provisions of ITA 2010, or a permanent establishment of any such company resident in another member state or a third country. So it's a Gibraltar company which is ordinarily resident and has assessable income. They are things that need to be satisfied. It's not just any GIBCO which is registered here, or a permanent establishment of a company resident in another country, as long as it meets the same tests of being ordinarily resident and of having a permanent establishment and having assessable income. So what does the restriction itself amount to? Well, a taxpayer, remembering that definition that we talked about before, will only be allowed a deduction for exceeding borrowing costs, remembering that that is interest cost minus interest income, a taxable income, in the year they are incurred to the greater of the following: either 30% of a taxpayer's EBITDA or 3 million euros. Everything else is disallowed as an expense. So you've got to go quite a long way to get 3 million euros worth of exceeding borrowing costs, but it's not impossible. I know of a couple of groups, especially in the property area, that have this. And if you do exceed that, then you look at the calculation of 30% of EBITDA. But still, it's important to understand that it may be rare, but it will occur probably on property holding groups will be the most common that you see it. And everything above that is disallowed. So it's just included in the taxable profit calculation. So that's quite a severe provision if you think about it. It doesn't have to be for avoidance. It doesn't have to be evasion. It doesn't have to be connected parties. It's just simply, you will only ever be allowed 30% of your EBITDA or 3 million euros in interest. And after that, you pay tax on it. So there are some exclusions. Loans contracted before the 17th of June 2016 are excluded from the provision, which is quite good. Loans used to finance a long-term public infrastructure project where the project operator, borrowing cost, assets and revenues are all within the European Union. And we're going to come to an exemption that we have further on the next slide, I think. And unutilized exceeding borrowing costs can be rolled forward indefinitely. We need to understand then, given that we have an exemption for long-term infrastructure projects, what a long-term public infrastructure project is. Well, first of all, that's a recognized public interest project. So building a power station, building some roads, all those things are exempt from the calculation. But secondly, we have a property letting exemption, which is a mirror, essentially, of the UK's provision, which has a similar exclusion. And it is, a business has a long-term public infrastructure project if it does the following. If it exclusively carries out a property business in relation to the property, and that business is letting real property or interests in land within GIB, and the borrowing costs in question are incurred in the purchase, development or renovation of the property, and the debt or financing arrangement is secured against the property, and at the date of the loan, the property is expected to generate income for a minimum of 10 years, and the property is recognized in the accounts of the company properly, and any lease or similar interest in land is granted for less than 50 years, and all transactions carried out by the taxpayer in relation to the property are carried out in accordance with the arm's length principle, and any income generated in the property by the property is taxable in Gibraltar. So there are quite a lot of things you need to meet to get this exclusion. But essentially what it means is, are you developing land? Have you secured the loans against the property? Are you granting leases of less than 50 years? And are you paying tax on the money? And do you recognize the property properly in your accounts? So you could build a block of flats and let them out on 3-year, even 49-year leases, and that would not be covered by the interest limitation. So I don't believe that those projects would be common in Gibraltar, but they may be possible, and it does allow for that kind of public properties to be built that, frankly, we have a need for reasonably priced letting properties, don't we, in Gibraltar? It's something that we talk about all the time. Well, a lot of you, the fiduciaries, are probably thinking, well, I don't have Gibraltar taxable income, so why is this relevant for me? It's relevant because this is a European provision. It covers every jurisdiction in Europe, and the Gibraltar provisions do have no effect on companies with no Gibraltar taxable income. That is correct, because they don't satisfy the definition of taxpayer. But if a company has taxable income elsewhere, then a similar provision will be relevant in that member state under ATAD. So if you had a GIBCO that owned a large amount of UK land, which it rented out and had mortgaged, as I know of several, who have a large amount of UK land which is rented out, then this will be relevant there, because you will need to calculate the EBITDA. You will need to calculate whether you're paying out more than 3 million. I mean, let's imagine you've got a portfolio of 500 million pounds worth of property, which is all mortgaged, and which is you're paying mortgage interest. You could very happily cross the 3 million threshold, and you would then need to look at your EBITDA. So it's big from the UK's perspective. So you need to think about those things, especially because after the 6th of April, the UK took all non-resident companies into the corporation tax regime, as opposed to the non-resident landlord regime, which they were in before. So if you maintain exceeding borrowing below the relevant thresholds, then you are guaranteed across the whole of the EU to be in a place where you can claim all of your deductible expenses. Though, of course, you should take advice in countries where the income is generated. We should not close our eyes to the other tax regimes which are relevant to us if we generate income, even if we don't think we've got a permanent establishment. We really need to be fully aware of the regimes in other countries. So another question I get asked is, well, my company only has bank debt. Why is this relevant to me? This is all done at third-party lending. It's all done as if at arm's length. It's perfectly, this is normal business. Why am I suddenly losing deductible expenses? Well, the interest limitation rule doesn't care. The interest limitation rule does not take into account the difference between third-party debt, bank debt, connected party debts, like the thing capitalisation rules do. It just talks about debt and interest. So therefore, it's not relevant that you only have bank debt. And I think it probably will cause a limited cooling of the amount of debt that people are borrowing instead of putting capital in, because where's the benefit? You don't get the deductible expense. I think it will have an impact on the amount of commercial borrowing that people take, whilst it won't eliminate it, but it will certainly be a consideration when people think about the size of their mortgages. They won't be thinking, oh, well, at least I'll get a deductible expense anymore, which will reduce my costs, and I can then go and invest my capital somewhere else and generate a bigger return. That borrow so that you can invest somewhere else, that is going to be limited by this, because the cost of the borrowing will rise. So what about consolidated groups? Well, consolidated groups are the 3 million figure is calculated across the entire group. This is not for individual companies. And there are complex rules around the treatment of individual parts of a consolidated group, which are beyond what we should be talking about in this session. So if you need to talk about those on a basis, please reach out to me. The legislation is there. Have a read, but you should be taking tax advice in a complex situation. So that's it. I hope you guys have seen the clarity, frankly, of the provisions. And are there any questions? Feel free. Has anybody got their hands up? No. for the second time running. It's all perfectly understood. Okay. So in that case, Catherine in the marketing team will circulate the slides to anybody who wants to see them. Feel free to email me if you have any queries. You don't want to ask them here in the session. That's fine as well. Just wait a minute or two, just in case anybody's feverishly typing. Okay. Right, well, thank you very much for your time. I hope that helped. We had a decent turnout in the end with 25 of you. Thank you very much. We're going to do another session next week, which is going to be on hybrid mismatches. It is quite a technical session. It is a bit longer. I'm just going to warn you. It is the driest topic of 4 very dry topics. And I apologize for that. But please come along. That will probably lead to some questions. And hopefully I will be understandable. Okay, so see you soon next week, and have a good rest of the week and a good weekend.